Alright then fellas, so this time around I want to talk about the crypto and stock crash that happened this past weekend. If you were paying attention to it as a potential investor or as a seasoned investor, then you would know that things got wild super fast. This crash wasn't just a dip, it was a cascade of liquidation, panic, and just a major red across these assets. So my goal in this video is to help you not only level up in-game, but also to level up in real life, specifically understanding and bettering your financial position. So understanding how this market crash happened, how to protect yourself from it, is part of building real financial power for yourself. So in today's video, I'm going to talk about exactly what triggered this crash, how it propagated, and what signals you should look out for, and essentially how to stay sharp when things are super volatile, when returns are big, short. So let's break it down. So the recap here is what exactly went down. So in a nutshell, $19 billion in leveraged crypto positions were liquidated in a short period of time. Bitcoin dropped more than 14%, Ethereum dropped 12%, and this was temporary luckily back in Monday or yesterday from this video. Um, Things did recover, just not fully, but more on that a bit later. Um, of course, we also have alternative coins. These coins saw a max drop between 40 and 70%. So these hits were a lot harder than Bitcoin and Ethereum. And a part of the recap here is also that markets outside of crypto were hit harder too, or hit hard, as to say, not harder. It specifically in riskier assets like tech. So Friday's crash was massive, fast. It just amplified the problem by leverage. So what began as a shock quickly turned into systemic unwind. So what triggered this? Essentially, it was just policy and global politics. The initial trigger was a surprising announcement from the U.S. government, essentially announcing that 100% tariffs on Chinese imports were going to kick in, and this reignited fears over uh, global trade instability, tech supply chains, and other growth economic prospects. So, because crypto markets are a 24/7 thing, when this news broke over the weekend, then there was no cool off session, there was no take some time. That no, there was no controls in place that traditional markets have that keeps you from investing after hours or during the weekend, unless you pay for certain privileges, right? But we all are, or the majority of us are, just regular stockholders or common stockholders. So we may not have a certain level of access. So this led to a leverage and liquidations, specifically a domino effect. So what this means is that because people because people had purchased high, when a certain price drops below a certain threshold that is unique to each crypto holder, then as the price goes beneath the threshold, then they are forced to sell. Especially this is unique to each investor because they invest a certain amount of money, and it also depends how much money are they investing, how much of a percentage does that count towards their overall portfolio. If it's a lot, then it's a very risky asset for them. So when the price goes down, then their small threshold of withstanding losses is a lot lower, and once it's pushed, they are forced to sell. So that also forces the price to drop down and cascade down to other investors that are more invested in Bitcoin as opposed to other people. So as the stress kicks in, people sell, and as people sell, price continues to drop down, and this is an endless cycle until the price reaches a certain point where it entices new investors that have a lower purchasing power and risk tolerance to crypto, and they buy. So when enough people sell, price pushes down where it entices new buyers to buy, and that helps stabilize the the price for a certain asset. And we saw this back on Monday, right? On Friday, things fell heavily because of the announcement, and back on Monday, first thing Monday, we saw a decent spike um, that shows some recovery, but not all. So that's essentially what happened uh, um, uh, from Friday to yesterday and Monday. Essentially a domino effect where one person sells, that pushes the price low, and then that pushes the next person to sell, and then selling until the price reaches a certain point where it entices new investors or continued investors with more assets or with more cash to invest. And so they go ahead and buy at that price, and that helps stabilize the market. So because this was a risky thing, there was some spillover to stocks and tech. Um, the crypto crash didn't stay isolated. The risk sentiment in markets surged and hit tech growth stocks. So essentially, what this means, it's the exact same thing, just in the stock market, when people are more invested in riskier assets like tech stocks, for example. And the same reasoning that I just mentioned about the price dropping and other people picking up that price at a discount also applied to the stock market, but specifically in tech, because it is more of a riskier asset. So the next section I want to talk about is the rebound and stabilization. So essentially what I just been covering right now. So after hitting bottom, Bitcoin rebounded to 114K, and other alternative coins recovered some of their losses. Some traders use this dip to buy undervalued entries, and of course, other people took the same opportunity to to increase the portfolio at a discount. However, the recovery is fragile, so volatility remains high, and the underlying stress hasn't fully resolved. So the bounce back in the market shows that it's trying to reset itself, but don't mistake it for full recovery yet. The next part I want to cover here is just the lessons learned. So we want to avoid excessive leverage. This magnifies both gains and losses. Diversify your exposure. Don't let a single asset or sector dictate your fortune. Don't let a single asset or sector dictate your fortune. So diversify your exposure. Use stop losses or hedges, basically options to protect yourself from downsides, and always leave a buffer between yourself and that asset, so you won't be forced to sell when things are panicking. So crashes teach brutal lessons. The smart traders survive by being ready and not letting themselves be swayed by the market. So what to watch going forward? We can be more active and say look into trade policies, rate announcements, inflation data, or just buy in a ETF or stock that has proven itself to be uh, good. And what good means is a good solid return of 10 to 12%, even 13% in some mutual funds that has proven to return that amount over the course of multiple years. So because it has a proven track record, and if you don't want to be more an active investor, then go ahead and invest in these stocks. You have the S&P 500. You have multiple variations of it throughout Vanguard, Schwab, and Fidelity. So you can invest in those if you don't want to be more on your toes when it comes to reading the market. So what does this mean for investors? So market sentiments swing faster after a crash. Sometimes this fear overshoots. Long-term holders may see an opportunity if they can stomach some of this volatility. For example, me, let's say I went from heavy green to light green this past Friday, but because I'm a long-term investor, I don't panic, I don't need the money that I have invested, then if I have extra money laying around, I could just buy some of these assets at a discount. And that's essentially what I did. So if a good investor or a long-term investor would have experienced a heavy green to a light green, or even just a regular green, a worried investor or a stressed out investor would have experienced some green and a heavy red. And heavy red is where we don't want to be at, right? So if you want to be able to stomach future crashes, invest in something that's stable, proven for the long run. And when something like this happens, you would see yourself experience heavy green to light green, then back to heavy green again in the future when people start to buy the same assets that you hold. So to end this video, I want to introduce a call to action to you guys. So the breakdown is simple. When something happens in geopolitics, things crash, markets crash, and there's a fragile recovery. If you're trading or investing, use what you learn here. So be careful with leverage. Always keep buffer space between you and the asset. Don't necessarily need the money that you have invested for other things. So and also never assume that a crash won't hit again. Crashes come in regularly, and this is the time to invest. Put your money to work at a discount. So alright then, fellas, I'm hopeful that this has cleared some things up versus to what happened recently. So if you want to learn more about financial topics, hit the like button and subscribe for more market dive thieves and other financial tools that we have at our disposal, but we don't necessarily know about them because we weren't taught this back in school. Alright then, fellas, later.
Suspect vehicle was last seen heading westbound. Quadrant has been authorized. Additional units will be provided in detail to the perimeter. Stay tuned for updates.
Charlie 29, roadblock set up east of his last known location.
Units on containment 5-1 advises you go mobile. Filing